Let's start with the jobs report. We'll move over to two Fed speakers, one on Thursday, one on Friday. Thursday was not a good day for the market or the bond market. Friday was a good day for the market, but not the bond market. What's going on? Labor, Friday, household, up 498,000. The establishment survey, up 303,000. Participation rate, 62.7, up 0.2. As this increases, it keeps down wage pressure. Unemployment rate 3.8, down 0.1. As this decreases, it increases wage pressure because there are fewer people left to hire. Was not a good report for lack of education. Lesson high school lost 143, high school down 82, lesson BA down 260. All the gains came from education, 568. Distribution in ages 16 to 19, plus 254, 20 to 24, plus 95. The 25 to 54 lost a little bit here, and 55 plus 234,000. Full-time, down 6. By the way, this is the fourth month in a row where full-time positions are negative. Part-time up 247,000. Part-time is full-time equivalents. But 4 months in a row of this shift from the establishment survey, 303. Private was 232, government 71, which is higher this month than the number in the last 12 months together. Not together, but on average. Healthcare added 81.3. This is healthcare and social assistance. And leisure and hospitality added 49. So 130 of the 230 came from two industries. Some good information in the industry section. Healthcare added 72,000. The 81 I have there is healthcare and social assistance. Healthcare 72, above the average monthly gain of 60,000 over the prior 12 months. Ambulatory healthcare services, hospitals, nursing and residential care facilities. Government increased 71, higher than the average monthly gain of 54 over the prior 12 months. Employment increased local government by 49, federal by 9. This is interesting. Construction, 39,000 jobs in March, double the average monthly gain of 19,000 over the prior 12 months. Specialty trade contractors, of that 39,000, specialty trade contractors up 16,000. Well, it is the spring, it is the building season. These are seasonally adjusted, which means that we would naturally expect an increase in employment in those sectors. And this is above that increase because these are seasonally adjusted numbers. Leisure and hospitality, up 49, has returned to its pre-pandemic February 2020 level. Anything else interesting in here? No, that's it. Average weekly hours increased by 0.1 to 34.4. Average hourly earnings increased, and it's not much, 0.347. That's 7 cents an hour. 4.25% annualized, which is on par with what we've seen. The average over the last 12 months have been 4.1. Combination of more hours per week and more per hour is 0.64% for average weekly earnings, or roughly 8% per year on average weekly earnings. But let's keep in mind, some of that is just working longer. That's not all wage inflation. This, if you're going to find a proxy for wage inflation, which isn't a great one, is average hourly earnings. The best number comes from the ECI, the Employment Cost Index, which we're in April. We should get at the end of April for the first quarter. Diffusion index, this is interesting. Total 59.4, previous 58.6. That means you have more businesses that are hiring. So the diffusion index is the number of businesses hiring versus the number of businesses that are reducing headcount. Anything over 50 is expansion. Manufacturing was 48.6, now 43.1, which is kind of at odds with the last PMI manufacturing that we saw. So that's sort of interesting there. Canada, not good. The expectation was for 25,000. Canada lost 2.2. Unemployment 6.1 now. The expectation was 5.9. It was previous 5.8. We are over 6% unemployment. We are losing jobs. Average hourly earnings, average hourly wage, year over year 5%, kind of in line with what we've seen over the last year. You have a Bank of Canada meeting this week. Unemployment now over 6%. I think is, I believe Bank of Canada is set to cut rates. If this had been a stronger jobs report, I would have changed my mind, but given that we are losing jobs and unemployment increasing, I don't think I'm going to change my mind. I have more to say on that later on. All in all, it was a fairly strong jobs report for the U.S. because as far as how much money will end up in the malls, you have people working more and getting paid more, so more money will head to Amazon and head to the malls. And the household and the establishment survey are both going in the same direction. The troubling thing you can point to is here. It's full-time jobs. Not much, 6,000. Considering the size of the labor force in the U.S., it's like a rounding error on a rounding error. But it's still 4 months in a row, less than zero. Okay, Friday. Michelle Bowman decided to mess up everybody in the bond market. 2 paragraphs right at the very end, and I think it's important to read how she's saying this. My baseline outlook continues to be that inflation will decline further, with the policy rate held steady at its current level, and that the labor market will remain strong, but with labor demand and supply gradually rebalancing as the number of job openings relative to unemployed workers declines. And should the incoming data continue to indicate that inflation is moving sustainably towards our 2% goal, it will eventually become appropriate to gradually lower the federal funds rate to prevent monetary policy from becoming overly restrictive. We are still not at the point where it is appropriate to lower the policy rate, and I continue to see a number of upside risks to inflation. My baseline outlook. Next paragraph. Well, it wasn't the next, it was after a bunch. This was right near the end. Decide to leave the stage with this message. While it is not my baseline outlook, I continue to see the risk that at a future meeting we may need to increase the policy rate further should progress on inflation stall or even reverse. While it is not my baseline outlook, and said that. So you wonder, well, you had to understand the effect that this would have. If you said raise rates, Powell is saying in many different places now that we are at the peak of this cycle. and it's not a question of how much higher, it's just a question of how long do we stay here. This is out of line with what the chair is saying. And you must have known the effect that this would have. So the question was, why include it? Why even write that paragraph in there? You had stated your baseline case. So this just could be pushing back against the relentless market rally that we're having because it does loosen financial conditions. We have SIFMA data now for the first 3 months, January, February, March, for bond issuance. And we'll have a look at that. And when you look at the increase year over year, you would think, wow, rates have really come down a lot, haven't they? Nope, rates actually went up. Q1 24 versus Q1 23, but bond issuance is up 80%. We're talking corporate bond issuance up 80%. So financial conditions are already loosening. And maybe this was a planned statement that was put in there to say, well, let's try some open mouth operations to see if we can't stop the market from potentially encouraging inflation, because oil prices, copper prices, aluminum prices, cocoa prices, all going straight up. And those are all inputs to something else, which means inflation could be rearing its ugly head again. So maybe that's what that was about. But that was a brutal line. That was one of those holy shit sentences. We may need to increase the policy rate further should progress on inflation stall or even reverse. Thursday, cash carry. Kashkari added that if inflation continued to come in stronger than hoped, he anticipates the Fed would hold its benchmark policy rate at the current range for a longer period of time. That's not such a bad statement overall. If that still did not work, further rate increases are not off the table, but they are also not a likely scenario given what we know now. Further increases are not off the table. Sort of made it an ugly Thursday. And then add to that what Bowman said on Friday. Both of them saying that neither one of these are their base case, but they're saying it. Mohammed El-Arian, Fed should wait a couple of years before cutting. Torsten Slock, AI frenzy would make it difficult to cut rates. And in quotes, we are absolutely in an AI bubble. He is not being equivocal about that. We are absolutely in an AI bubble. So maybe we can sort of think about why Fed speakers would say that, especially after Powell has said, and even in front of Congress, we are at the end of this rate hiking cycle. We are at peak rates. Why they would say, more rate hikes are not off the table at this point. Again, when you think about oil, when you think about copper, when you think about gasoline, when you think about cocoa, when you think about aluminum, when you think about all these input prices rising, and if they also believe we are in an AI bubble, with stock market making new highs every day, and you've got record issuance of corporate debt. Ouch. We haven't even started to lower rates yet, so that could be what's going on here. Bank of America, if the first rate cut is not in June, then no cuts into an election. They don't see them taking a chance on changing the fate of the election by cutting rates and potentially, making something better or making something worse. Better to just keep their hands off the controls. That's Bank of America's opinion. If they don't cut in June and start the process and say, look, we already started this process way back. It had nothing to do with the election. As the election gets closer, the committee will be more and more reluctant to do anything until after the election. Okay, now we can look at our rates in context. Money market rates, you wouldn't expect much to happen there because they will track very closely with the Fed. In case I haven't drawn this out for you, you can sort of put a little imaginary line here. There's your money market, there's your capital market. And your money market rates are your 1 month, 2 month, 3 month, 4 month, 6 month, and 1 year. And they will reflect the policy rate. And then you have your 2 year. Your 2 year is lower than your 1 year. You see here at 4.73 versus 5.05. And you have an inverted yield curve. These tend to reflect expectation of real GDP and your inflation expectations. So future expectations show up in the capital market curve. Future, you can call them fundamental expectations, where money market rates really reflect the policy rate. And so we see very little movement here because it doesn't really matter what Fed speak is. It's not going to affect the money market rates. But look what happened to capital market rates here. Right, you have more bear steepening going on. Steepening because the curve is coming up. Have a look down here. All of them increased, so they're less inverted and some are upward sloping at this point. Bearish because rates are going up, bond prices go down, that is bearish. So more bear steepening on the capital market curve. Inversion, we're still inverted. The 2 to the 10s, that's a record, 627. The 3 to the 10, 510, 510 days, that's a record as well. I can't look past that. I just can't get past that inversion because this is the cost of money, and that does matter. Leading economic indicators had shown or had been at a point where they were predicting a recession. They said, look, this is not a recession warning. This is a recession outlook at this point, and now it seems to have turned around. You can make the case that maybe it's not as relevant as it used to be because of what it's measuring, but the cost of money is the cost of money. That is relevant for everybody out there. So I cannot ignore the length of time. Now, I have said before that with financial sophistication, many companies are much more immune from interest rate changes than, let's say, 15 years ago or 20 years ago. So every time you get to these rate hiking cycles, more and more of the economy is immune from it. But all of these things that they do have a time period. There aren't 50-year swaps where you're done for the rest of your corporate life. These are usually anywhere from 2-year, 3-year, 5-year swaps. So the longer this continues on, the more those swaps have to reset at higher rates. And it's not as if we think of a timeline, a swap was taken out just before the rate increases and we have 5 years. They're all along the way. Every time there's debt that's taken out, there is some sort of protection put in there. So these expire at some point, these expire at some point, these expire at some point, and these could be 1 year. Some of them could be 3 year. If they have debt that has a maturity of 3, they'll use 3. It could be 5 year. The longer you have this inversion, the more of these swaps have to be reset so that the average cost of that debt across all companies would be rising. I just can't look past the inversion to think that, okay, not only are we not going to have a soft landing, we're going to have no landing with record inversions. I don't know if I'm alone on that one, but I'm still hesitant about this market, and especially with the forward multiple being over 20. I'm just looking at all this thing, but it just, years of experience tell me that this is still something I'm concerned about. Canada, the inversion 62.9, 145, much deeper than it is in the U.S. And Canada having more difficulty because we are both household and businesses less immune to interest rate hikes because we don't have the same level of financial sophistication. Our mortgages are not 30-year fixed. They're 30-year fixed in the U.S. because that's a great way to securitize an asset. When a mortgage is a 25-year amortization with 5-year reset periods, difficult to securitize those. Look at the balance sheet. The SOMA security runoff, $43.5 billion, down to $6.85 billion in that facility. The balance sheet sitting at $7.439, down $45 billion. Less the SOMA, you have a net runoff in other areas of $1.6 billion. Money market fund assets, this is a head scratcher, increased $70 billion. $70 billion. You would think that, as the market is going up, it's pulling money out of money market funds. If you have a pullback, which we had this week, we had lots of volatility and a pullback, that money would be waiting for an opportunity here. And I would have thought, well, okay, we'll have a drawdown here. And no, we had an increase, $70 billion. Retail up 25, institution up 45. You have plus signs everywhere. So money is uninterested in being in other places now. Now, it's hard to tell what this is for because you have tax season coming up. And maybe money is moving out of other assets and moving into money market securities because taxes are due April 15th. It could be that money is just simply moving somewhere to earn a return or earn a yield before it has to be paid to the Treasury on the 15th. That could be what is going on here. Okay, our next FOMC, 24 days away. And when it's 24 days away, we know we have our minutes coming up. And there it is right there, FOMC minutes in 3 days. It's a big week this week for risk. Big week. Earnings start this week as well. And you have the minutes. And then our two guilty parties from the Fed, Kashkari, is going to be talking on Monday, in case you didn't hear him Thursday. And Michelle Bowman is going to be talking on Wednesday, in case you didn't hear her on Friday. I wonder if they'll be pushed into answering questions about what they said Thursday and Friday. CPI for the U.S. is in 3 days. That's going to be big. That is going to be big. I would look for positioning on Monday and Tuesday ahead of that. Let's see what tone Kashkari sets on Monday. Then you'll get CPI on Wednesday. Then you'll get Bowman on Wednesday as well. And if you're in Canada, if that's not enough for you, you got your Bank of Canada rate decision going on that day as well. I'm expecting a cut. I'm expecting a cut at this one, based on that last jobs report, based on the last CPI report, where CPI really took a step down, and based on the sheer amount of household debt that Canadians have, and the lack of immunity they have to change in rates. The increase in delinquencies, mortgage delinquencies, in the fourth quarter of 23, I think it was up like 56%, 135% increase in Ontario alone. Yeah, I'm thinking that's the time to go. PPI in the U.S. on Thursday, and also if you're into the grains, the WASD report is in 4 days as well. For the May FOMC, 93% probability of nothing. I think that's probably right. I think June will be your first one. I think May will be your announcement on the balance sheet, which will be some form of easing. If they announce some sort of taper, and when that taper starts, that is a form of easing, because if they're letting fewer securities run off, that means they would be buying incrementally more each month, right? So incrementally more than they are now, while still tapering the balance sheet. So I think May, look for balance sheet announcements. June, look for your 25 basis point cut. But this is a big one, and we've seen prices in key commodities just going straight up. You got a lot of Fed speak this week as well. Wednesday, Goolsbee. Thursday, Williams, Collins, Bostic. Friday, Bostic Daily. You have two auctions this week as well. You have on Wednesday the 10-year. So you got CPI on Wednesday, you got the FOMC minutes, you got Bowman again, and you're going to have a 10-year testing the market's guess on where the yield should be. And then on Thursday, you have the 30-year going out to December. 4 or more rate cuts, 30% probability last week, down to only 20% probability this week. New York Fed effective federal funds rate 5.33. Our lag is still 50 basis points. Look at what happened to reverse repo. I said you can't really read too much into last Thursday, because it's not only the end of the month, it's the end of the quarter, and it's a long weekend. April 5th down to 438 billion. 413 I think was the low. So we're at 438, drop of 156. Based on where we started the year, the balance at the year, and the balance today being 438, if you then extrapolate that and run it further on a linear decline, June 15th is the zero date on the RRP, which means May, you're going to have some kind of conversation about the balance sheet, because once you hit zero, there is no excess liquidity in the repo market. And if there isn't, then you'd have to start thinking that as you continue to run off your balance sheet, it's going to come out of reserves at that rate, and they want to do it at a slower rate to approach the ample reserves number at a slower speed. TGA has dropped 40 billion down to 732. TGA is buying back some bonds, not for debt reduction, but for cash management reasons, because they get a whole bunch of money in April 15th that it's just going to sit around and do nothing. So the Treasury doesn't really invest that money. It just buys back certain securities and saves the interest, which is the same as investing it. They're just investing in their own securities. So they just buy it back for a period of time until they need to draw it down to 732. They're going to try to hold close to 750. So as money starts coming in, they will then start to buy back some securities to try to stay around the 750. Reserves down, up to 3.54, up 68 billion. You had reverse repo down 156, reserves up 68. So if we add the two together and subtract what we think is ample, we get 1.49 at the runoff that we have now. That's 15.7 months. I look to the May meeting for a change in the amount of runoff, some start date and a change in the amount of runoff to extend this from 15 months, maybe out to as far as 30 months. That would mean cutting in half the amount of runoff, at least from treasuries. I don't think they're going to do anything on mortgage-backed securities because the runoff is too low. The runoff on mortgage-backed securities will pick up pace as soon as interest rates start going down. If the interest rates are going down, you may get some refinancing of mortgages, and you will have higher prepayments, and you'll have a higher runoff on the MBS, which they want to get rid of anyways. I would look for a cut in the amount of treasuries they allow to run off, which will support the longer end of the treasury market. Real rates all following suit with nominal rates all up, and you have from the 10-year out to the 30-year now over 2%, and the 7-year and the 5-year just shy of that 2% this week. Will change everything because you have cash carry, Bowman, CPI, and the minutes all coming out. CPI is going to be the big thing. Either next week these will both be over 2, or these will all be under 2. I think a lot hinges on that CPI report. Let's look at Fed funds futures, and I've got it all the way out to the end of the first quarter of 2025. For Q2, pricing in a 9.5 basis points lower by the end of Q3, another 21.5 by the end of Q4, another 26. The market has got 2 rate cuts versus 3 for the Fed. I still continue to believe that long the December Fed fund futures makes a lot of sense, and I'm not going to change that position, even though it's temporarily not working out. I'm not going to change that position. TLT had an ugly week, down 3.41% to SPX's 1% drop. Implied volatility coming back, making it a little bit more exciting. 13-week implied volatility at the 33rd percentile. So a couple of interesting things here. May puts, 41 days to expiration. I like the 93 puts and the 94 puts. I know we're at 91.42, but my belief is that we are coming higher. 93 has got 245 in it. I want to take advantage of the implied volatility here. My break even is 90.55. I'm good with that. The 94 has got 315 of premium. Break even is 90.85. I guess on Monday I would wait for cash carry. I don't see that he would change his mind from Thursday to Monday unless he saw the market reaction and said, oops, I didn't mean to do that. But I don't think he's going to do that. That if pressed, I think he will repeat the same thing, that look, if inflation does come in higher, and of course we won't see inflation till Wednesday, so the market will be nervous, he could push TLT a bit lower. I'll wait to see what the action is on TLT that day, but I like the 93 puts and the 94 puts for May. Another interesting play is January of 2025. The 93 calls are $4.85. So buying a call is $485. That is the most that you're risking. And if the week is good and CPI is benign, you will get a rally in TLT, which will put this in a win position. Then I would look to sell the $100 call against it. I don't know that I want to sell the $100 call right away. Although it's a good return, it's about $2.50. It would cost you $250 for the spread, and it's a $7 spread. So that's not too bad. Risk $250 to make $700. You know, and if you're doing it at volume, you're risking $2,500 to potentially return $7,000. That is not bad. But I would step into that spread. I'd buy the 93 call first, and then I would just wait. But I'm more likely to do the May puts. Okay, housing. A lot of really interesting stuff here on both sides of the border. Opposite stories. Let's look at our mortgage rate, 6.82, edged up a bit. The 10-year Treasury over the same period was up 11. 30-year FRM was up 3, so the spread narrowed by 8, sitting at 251. Meredith Whitney this week. Housing prices in the U.S. to begin a multi-year long decline, about 20% lower than today. A multi-year long decline. Thinks demand being greater than supply will invert to supply being greater than demand. And her argument is demographic. The bulk of housing, 90% of housing is owned by people over 40. 74% is by people over 50. And 56% are by people over 60. And that these will eventually be hitting the market, given the distribution of death rates, that these will be hitting the market as the owners pass on. 56% of housing is held by people over the age of 60. And you do have a situation where demand is greater than supply, because you do have immigration now hitting around the 3 million annual mark that have to find a place to go. So if these start hitting the market, this is where the supply shifts over to greater than demand. That would be a tough one for the housing stocks, the house builder stocks, if we did start to see that. But that is a slow-moving thing. That's not just going to happen overnight. You would see it coming, but that is a bold statement. A multi-year long decline. Now let's go to Canada, where it's the exact opposite thing. CMHC, the Canadian Mortgage Housing Corporation, Canada housing prices could reach new highs by 2026. We'll look at the report shortly. CAR.UN, which is Cap REIT, an apartment REIT in Canada. I bought 10,100 shares last week. It broke $45. That's what I was waiting for, about 10,100. I'm looking to add another 20 to 30,000 more. And you'll see what my thesis is when we look at the highlights from the CMHC report, which I agree with entirely. I just wish there were a national home builder in Canada that I could buy into, but there just isn't. We'll read that in a second. Let's look at our corporate data. OAS is really not showing a lot of excitement, although there is a little bit of concern here on CCC. Corporate bond issuance, this is, we have March in now. Issuance year to date, January, February, March, is 81% higher than January, February, March of last year. 81% higher. For March, investment grade was 141 billion. Last March, it was only 103, roughly 40% higher. High yield, 26 billion versus 4.6 billion. That's some 600% higher. And convertible, 2.3 billion, no convertible last year. Let's look at this CMHC report. The link for this is in the description box. This is the 2024 housing market outlook. You can click on just read the insights and it drops you down to here. Economic growth outlook, expecting weak economic growth in 2024, a momentum regain in 25-26 as interest rates decrease. Housing starts prediction, lower housing starts in 2024. Slight improved forecast over the next 2 years. Supply challenges, notably the lagged effect of higher interest rates, means that new construction in 25-26 won't reach 21-23 levels. This is what higher interest rates do to supply. It actually makes it worse by restricting supply, because big projects like this need financing. And the higher the cost of financing, the less likely they are to be done at any kind of scale, which will produce spec houses, extra supply with no buyer. Price forecast, forecasting demand to push MLS prices beyond the previous peak levels. This indicates a lack of short-term affordability improvement. Push prices beyond the peak levels in 2022. Early January, February, housing prices were just insane. They're much more relaxed now. So at that time, one agent told me that I could list my house for almost $2 million. Now I'm being told that if I want to clear my house quickly, I'd be listing it at 1.45 to 1.5. So I'm going to hold. I'm not going to sell. I'm going to hold. I'm going to wait to see if this happens. Sales rebound, foreseeing an increase in MLS sales due to strong population growth. Well, we do have that. Sales are expected to surpass the past 10-year average levels. but remain below the record 2020-2021. This is the level of sales, not the sales price. Rental housing demand. Despite more rental completions, growing demand for rental homes will not be met because the cost of home ownership will lead households to stay in rental housing. Rents will rise and vacancy rates will fall. I've been saying that for quite some time with the number of people, our liberal, well, your liberal government's not ours anymore. I'm not Canadian. I am a Canadian citizen. I'm just not a Canadian resident. That the liberal government wants to let in. They have to live somewhere. So when I see cap rate below $45 a share, I have no choice but to load up on it. That's going to be a beautiful holding for me. I'm waiting for Killam to drop below. I'd like to see it below 15.50, below 15, and InterRent, I'd like to see it hit below 12. If these trends continue on, I will load up on all of them, because where are they going to go? Where are they going to go? And immigration is not going to slow down. So let's go down here, see what else we can find. Expect a gradual each of these points are in more detail down here. Housing starts decline in 2024. That's just going to support existing housing prices. Regional outlook. Ontario and British Columbia expected to drive the decline in national housing starts for 2024. High home prices will make certain home types unaffordable, while developers may struggle even with apartment construction because of supply-side challenges, particularly financing costs. That's what I want to see. They will struggle with apartment construction, so even fewer of those coming onto the market. The only way that I can get exposure to the Canadian housing market is through apartment REITs. I really, really would like to see a national home builder, but we just don't have one. So apartment REITs is how you play this one. Sales and prices will rise in the coming years. Strong population growth recorded in 2023, the highest since the 1950s, will continue into 2024. This will contribute to the recovery in sales. This resurgence will also be driven by a shift in demand towards lower priced homes and markets in Canada. We project sales levels in 25-26 to slightly surpass the past 10-year average. Rental demand will continue to outpace supply. Despite some recovery in home ownership demand, many households will struggle to afford homes in 24-26, leading to increased demand for rentals. Strong population growth will further increase rental housing demand because newcomers tend to rent after arriving to Canada. And then alternative scenarios. I will leave this for you, but you can actually download the whole report if you want the full report, or you could just click on each of the areas if you're more interested in what's going on in Toronto. This will give you some information. I should add, before we move on to Tesla here, there's a lot to say here, a lot going on. I should add, back on the apartment REITs, once interest rates start coming down, because REITs are very bond-like in their cash flows, they do have duration that will support pricing as well. I don't know, once a year, or at least every year, there's always one thing you have that you have this really high conviction on. I don't know if I've had higher conviction on anything in the last few years than Canadian apartment REITs. Given the growth in our population, given the unaffordability of housing, and the already low vacancy rates, they have a lot of pricing power. And again, where are they going to go? I don't know if I've had a higher conviction, which is why I'm perfectly willing to put up to 10, even 15% of my entire portfolio just into Canadian REITs. Let's look at Tesla. Tesla's going to be attacked. Well, they're being attacked in a number of ways, and I believe they're going to be attacked in a way that hasn't really hit the media yet. April 17th to the 19th, Volkswagen. Let's put an N on the end of that. The Volkswagen assembly plant in Tennessee has a union vote. This is their third attempt. The UAW has never unionized a non-US plant. This is critical. They get a win over here. I guarantee you they're going to make a run for Tesla. Here is a quote from the UAW. Workers at other non-union plants in the US, including those not owned by foreign automakers, that is Tesla. There's only one other one. They own the three already. Have approached the UAW. And I said this with the big wins of the UAW in the fall, that inside the UAW right now there's a task team whose sole focus is Tesla. They're going to unionize that company, or at least make a very big run at unionizing that company. So I think it's not Tesla's news yet, it's Volkswagen's news, but I would be watching this union vote April 17th to 19th. That's a Wednesday to a Friday. Probably won't have the results till Saturday morning. But watch this one. If they get a win over here, I don't know what stops them. I don't know what stops their momentum. Tesla did report its numbers for Q1 delivery. Not good, down 9% year over year, negative growth. So this, 50% for the next 10 years, 100% of the market to the moon. Diamond Hands business is gone. Q1 production, the Model 3 and Model Y, 412,000. That's negative growth in production of that year over year, and a drop of 9% in deliveries. This is global. MotorIntelligence.com thinks the U.S. was down 13%. A drop or growth, a larger growth there. The forecast now is for 2 million deliveries in 2024, which is about 10% growth over 2023. I don't know. I mean, you've had a drop of 9% here. You'd have to have significant gains in the quarters coming up to hit that 10%. I sort of think that they'll either be flat or less than 0 for 2024. U.S. vehicle sales, we got those numbers in as well, which makes this 9% even more troubling. A run rate of 15.4 million for 2024. That is nice. Q1 2024 auto sales, U.S. vehicle sales up 5% year over year. And MotorIntelligence.com thinks Tesla's U.S. delivery numbers were down 13% in the quarter year over year. That's a big difference. Average sales price 44,186, down 3.6% year over year. Remember now, new vehicles make up 4% of CPI. Used vehicles make up another 4% of CPI. So if new vehicles are coming down in price, used vehicles are. What makes this number even more interesting, this drop of 3.6, it's the largest recorded decline for the month of March. Discounts are increasing. They're about 2/3 higher, about 2,800 per vehicle to try to move vehicles. Inventory on lots is growing to pre-pandemic levels. So this idea of paying above sticker and waiting 2 years to have your car delivered, that's sort of gone. But that is a big price decline year over year, 3.6%. And again, it makes up 8% of the CPI. So supply chain issues are solving their own problem. EVs, the thinking or the numbers broken out from U.S. vehicle sales. EVs were up 2.7%. Sales up 5%. EVs only up 2.7%. If you go back to Q1 2023 over Q1 2022, EV sales were up 47%. They're only up 2.7%, with Tesla being down 9%. Market share 7.1% now versus 7.6% last year. And on Saturday, announcement Model Y SUV. Actually, sorry, not on Saturday. I found this on Saturday. It was during the week. The Model Y SUV inventories have been increasing. Price cuts as much as $7,500 per vehicle last week. Reuters reported that Tesla canceled its Model 2. That's the $25,000 EV. Canceled its Model 2 and is going to focus on robo-taxis. Dan Ives, long-time bull. A dark cloud moment for Tesla. Major punch in the gut for Tesla bulls. Now, Musk did come out on X and say Reuters is telling lies again. Dan Ives was saying it would be a dark cloud moment for Tesla and a major punch in the gut if this were true, if they were canceling the Model 2 and focusing on robotaxi. Technalysis research, practical reality, as this is many years off. And Musk on X late Friday after the market closed. Robotaxi unveiled August 8th, this August 8th. Nobody in the full self-driving universe believes that full self-driving is just around the corner, especially 4 months from now. Nobody believes it. The most aggressive estimates are that it's years off. I think it's decades off. I think it's at least 20 years off. The big problem with the robotaxi, at least the way Tesla envisions it, is that you can buy one of these vehicles and then you can have it go out and earn money for you. That there'd be millions of these on the road. People are going to buy them because the car will pay for itself, because out it goes, out it goes. That's not going to work in a lot of countries in the world. Right away, I can tell you, if you think that you can put a self-driving car on the roads in San Jose, Costa Rica, you're out of your freaking mind. There's simply just no way. There's anybody who's driven around here will tell you right away that it's going to be impossible. A lot of other countries as well are just as bad. So you're really looking at developed countries. Here's the problem. Tell your insurance company what you want to do. Call your insurance company up and say, hey, listen, I'm actually going to get a vehicle. I'd like insurance, but it's going to be a commercial vehicle as well. I'm going to earn some money on it. Oh yeah, and I won't actually be driving it. No one will actually be driving it. It'll drive itself and it'll drive passengers around. Can I get some insurance on that? Good luck getting insurance. Now, the other option is, well, then Tesla will just provide all the insurance for that. Well, all you need are a few accidents. All you need is one where somebody dies. All you need is one where somebody dies. And every lawyer in America is going to want to jump on board that. And if Tesla is the insurance company, that's just another big source of risk. Not only that, the technology just doesn't exist. So I think they're trying very, very hard not to be a car company. I think that's why they canceled number 2, because if they brought that in that low cost one, they are competing against other car companies for selling cars. And I think they're trying very, very hard not to be a car company. I don't expect much on this one. It may even be like the robot, where they don't actually have a robo-taxi. Maybe they just have somebody dressed as a robo-taxi. Okay, the MicroStrategy ARB is working out quite nicely. Down 15.58% since the October 28th closing. I presented it last Sunday. It wasn't my idea. I read it and I thought, what a brilliant idea. And I said that I'm jealous I didn't think about it. But it is a brilliant idea. Down 15.58%. Bitcoin is down 3.7% over the same period. So it is having its effect. BTIG disagrees. And I'm left with nothing but question marks on this. We think the implied premium of the company's Bitcoin holdings has drifted into a new norm above 2x. And they noted, well, last year it was 1.5. Yeah, but last year you didn't have ETFs. Last year this was a sort of an interesting way to play Bitcoin without actually having to buy the Bitcoin. But now you have ETFs. Why would you ever pay double? Why would you ever why ever justify a premium? I don't understand that. If MicroStrategy started holding U.S. Treasuries, would you then say, well, they should be valued at twice what a U.S. Treasury is if they're on MicroStrategy's balance sheet? I don't understand why a Bitcoin on this company's balance sheet, which has a traded price, which has options for everybody to hold at its normal market price, why would you ever make an argument that, well, you should pay double if MicroStrategy is holding it? I don't understand that. And the only argument, well, last year it was 1.5, it should be 2. So in a couple of years, you should pay triple? Doesn't make any sense. We also expect the company to benefit from Bitcoin catalysts during the coming year, especially the Bitcoin halving event. Why? Every ETF would benefit. If the Bitcoin does something, every ETF would have the exact same reaction without paying a premium for it. So again, I'm not understanding why you would pay a premium for an event that would affect anybody who bought it without a premium. If the only way that this catalyst, this halving, affects MicroStrategy is if it actually affects the price of Bitcoin. And if it affects the price of Bitcoin, why not pay the market price for Bitcoin instead of paying twice the market price for Bitcoin? This argument to me is, I don't know, maybe they got paid money by MicroStrategy to try to boost the stock price for a period of time, because it just seems like such an obvious statement to make. I don't know. Anybody's got any ideas what BTIG is up to on this one? Please help me out. Okay, let's have a look at copper and gold. Let's start with copper. There is the China smelter news. You have a gap up in the price. China PMI data. Oh, China is doing better than we thought. It's not actually, but it's doing better than we thought. And you have a top here, and looks like you have what, 1, 2, double top, maybe a triple. And technical analysts like to say there are no triple tops. FCX sitting at 49.47. 52-week high is 50.24, just under their 52-week high. Their big mine in Indonesia, their big copper producing mine, produces gold as a byproduct. Produces so much gold as a byproduct that when you look at the unit cost of copper, it is less than zero. In other words, after selling the gold, their copper's free. And look at gold. I mean, everything is working out for Freeport at this point. COPX sitting at 44.64, 52-week high of 45.59 year to date. Both of these outperforming the S&P by a healthy margin, almost by double. COPX almost by double. Gold broke out of a long-term trend. This is a 2-year chart of gold. Broke out of a long-term sideways trend here, and is just running. I mean, it's not even trying to do it rationally. It's just leaps and bounds. China Central Bank is buying along with Chinese investors, because they're not putting their money in housing and they're not putting their money in stocks. And to a degree, Bitcoin is not allowed. To a degree. I mean, you can still get around the rules, but the strict rules are it's not allowed. So many investors will probably side with caution, say, wow, we better not do it, but gold is fully allowed. GC, the April contract for gold, ended at 23.28. I'd like to say that, with the inflation data coming out this week, it might affect the direction of gold, but it doesn't seem to be, because we do have the idea of interest rate cuts, and lower rates usually are supportive for gold. But over the last week, cuts got pushed out further and further, but gold still kept going up. Gold usually responds to certain catalysts, and now gold is going up no matter what is happening. So I think that is because of what's going on with China. So with the CPI report on Wednesday, gold is going up. If the CPI report comes in hot, gold will go up. If the CPI report comes in lower than expected, gold will go up. I don't know. What do you say when you have momentum, right? And that is what gold has right now, is momentum. And when something has momentum like this, it attracts more and more momentum traders. And momentum is your friend, right? Yeah, you hear the expression, momentum is your friend till the end. And when momentum breaks, it breaks. But right now, it has broken out. Technically, it's got nothing but air above it, and it is under momentum right now. West Texas, 86.73. Brent has peaked over $90. Looking over the $90 mark. Oxy 69.25. 52-week high 69.58. Call it a 52-week high at this point, pushing $70. Here is oil, West Texas Intermediate. Here is gasoline. Here is natural gas. Not coming along for the ride. The US dollar also not going along for the ride. You have gold prices up. Canada's a big gold producer and exporter. You have copper prices up. Canada produces copper and exports. You have oil prices up. Canada does the same thing. That in the past has always supported the Canadian dollar. The Canadian dollar, as I was watching it last week, looked like it wanted to go along for the ride. Broke below 135, got to 134.8, 134.7, and I thought, okay, I see 133, 132. I'll convert some more of my Canadian to US. And then it just didn't happen. Just not going along for the ride yet. Natural gas is not going along for the ride. In case you think natural gas is going to go along for the ride, it's used for different things. Oil and gasoline are used for transportation, natural gas for heating. Morgan Stanley, if you are a fan of natural gas, you're not going to like this. Morgan Stanley expects the supply glut to continue to grow to multi-decade highs. The U.S. This year recorded its warmest winter on record. The EU and Japan both recorded their second warmest winter on record, and much warmer winters are the trend going forward. So natural gas is probably got more downside to it. Can it break a buck? Can we see 99 cents on this thing? It's getting some support right around $1.70. Bounced off $1.70, came back down, bounced off $1.70, heading back down, and of course it didn't bounce very high. So you break 170, what's to the downside on this thing, right? Natural gas is tough to play because it's a big contract, right? The multiplier is 10,000. So you know, you get any kind of shock in that market, and it can bankrupt you overnight. I wouldn't touch natural gas at all. I wouldn't short it. I wouldn't buy it. I would just stay away from it. What you can do is you can look at who the big natural gas producers are. Their stock will be under pressure. Anybody in the shale play does as a result produce natural gas. So it's not helping them out. So oil companies are moving up on the strength of the underlying commodity. You have consolidation going on in that sector. I've mentioned this before. With consolidation, you will always have a minimization of supply. I shouldn't say minimization, but a reduction in supply, because marginal wells will be shut down. And more focus will be given to extracting oil out of the existing higher margin wells, and those marginal ones will be shut down. To get an idea of how we should be thinking about oil going forward, watch the Baker Hughes rig count, because you need a rig for each oil well you have. So watch the rig count, and if you see that slowly decreasing, that is an indication that supply will slowly be squeezed as well. This is will show up in CPI, in headline CPI, but once you remove energy and food, the volatile components, you look at core. The longer this stays higher, the more it shows up in transportation, in shipping costs, in the costs of items on the shelf in stores, because this whole economy runs on energy. So the higher or the longer it stays here, the more likely it is to feed through to prices. Okay, SPY. I will pass on the Russel this week. Just I don't know that it's that interesting. Did it for a couple of weeks, but I just every time I look at it, I think this is not that interesting. SPY forward 4-quarter operating earnings 251. The reason for the jump is we are now moving forward a quarter. We are looking at Q2 24 to Q1 25, not just 2024. SPGlobal 249, which puts our forward multiple, even at the big jump up, puts our forward multiple at 20.78, still sitting over 20 times forward earnings. Look at implied volatility. It is back. I just don't like these. I just don't like the levels that we're at and the multiple that we're at. But I wouldn't sell a call, and I wouldn't sell a put. So it's sort of wasted implied volatility, I think. 522.95, the all-time high, and we are at 518 and change, down 0.86 from the all-time high. I don't know if Monday or Tuesday, in front of a CPI report, and the Fed minutes and Michelle Bowman talking again are going to see a market that can hit new highs. Or it could, if there is follow through from Friday's job report, where the market says, who cares what inflation is? Higher inflation just means higher revenues. And AI will mean lower costs because we can increase productivity. So who the hell at this point, who the hell cares, right? AI, and off we go. We could keep going up. Nvidia 880, another week where week over week it is down, having trouble over the $900 mark, sitting at 36, 37 times forward sales. You had some earthquake issue in around the Taiwan region. Maybe that is causing some issue on the thought about what that means for supply. But having trouble at the $900 mark. We are entering earnings season. This week we start to get some earnings reports. I should have mentioned Tesla's April 23rd. NVIDIA's way at the end. NVIDIA's way in May. They're way at the tail end of earnings. We get everybody's earnings first. We get all of that. And then you get NVIDIA's earnings. So the closer you get to earnings, the less likely the market is going to keep hitting new highs, because everything will be built up, because we are AI fueled. So it's going to mean something. But 2 weeks in a row now being down. Maybe it's just consolidating sideways. I looked at the puts. I really don't like any of them. I looked at the 720s. I think it offered $315 for the 720s, $3.15. But you need something like 10,400 in margin for that. So 315 over 10.4 for 41 days. I didn't like it, even though it has kind of decent implied volatility. I still didn't like those numbers, so I'm not too excited about anything there. And let's just finish up with a look ahead this week on who's reporting earnings. Kind of hard to pull apart who's trailing in their earnings report from last quarter versus starting this quarter. JP Morgan Friday morning, along with State Street and Wells Fargo, along with BlackRock, JP Morgan, State Street, and Wells Fargo, 4 financials on Friday morning. And then going into next week, we have a whole bunch of financials. What else do we have this week? Wednesday, Delta Airlines. Thursday, CarMax, along with Constellation Brands and Fastenal, which I think are trailing. They're the last, the stragglers from the last quarter. I don't think they're Q1. I think they're the last ones for the last quarter. I think Q1 starts on Friday with BlackRock, JP Morgan, State Street, and Wells Fargo. Big week, CPI, Fed minutes, Bank of Canada, PPI, earnings, and you have Kashkari and Bowman. So buckle up.